Hello, Vetted VA, and welcome back. It is Tuesday, so I am here with several of our expert moderators from the forums, and we're going to cover a topic for you again. An interesting one, an important one tonight. We're going to be talking about closing costs. One of the most common misconceptions that we get in moderating in the forums is people thinking that they have financed their closing costs or that they didn't have closing costs. So we're going to go at this from all different angles, kind of talk about them. Our guests are here from different parts of the country. Well, actually, we got 2 Californians and 2 from Wisconsin, so we ignored the other 48 states. We doubled up on 2 states and we ignored the other 48. But we have sort of upper Midwest and then left coast here. So we'll cover at least 2 states for you in terms of how closing costs work. But for the most part, they don't vary from state to state. So our guest tonight here, Matt, I've never asked you the correct pronunciation of your last name. Titel?
It's Titel, yeah.
Title. I figured whichever way I went, it was going to be wrong. So I'm glad you corrected me. And then we've got James Mercado, also in Wisconsin, and Lindsay McCoy up in Folsom, California, just a few hours north of me. So thank you all for joining us tonight. I want to remind everyone watching, the most important part of the show is not the topic that we're covering. We would love to answer your questions live. So if you're here and watching, throw a question in the comments. We'll see it over here in the feed. And as soon as we have time, we will get to it. And it doesn't matter, VA related, non-VA related, mortgage, real estate, if it's on topic, anything under that umbrella, let us know. And we are happy to answer it. So with that, why don't we jump in? Lindsay, can you walk us through when you're doing a pre-approval? What are you preparing your borrower? Like, hopefully, when you've told them, hey, you qualify for X, here's what your payment looks like. But the part we're talking about tonight is your closing costs, prepaids, everything you need to bring to close, including your down payment if a veteran chose to make the down payment. But how do you go through that with your borrowers when you're going through a pre-approval to let them know there will be some costs, even though they are not required to make a down payment?
Yeah, a couple things that I say in the pre-approval process are there are some costs that are not covered by your loan. And let's say we're doing 100% financing and the veteran is choosing not to put any money down. I know that in most states, but in California, we absolutely have earnest money deposits. So we talk about 2 things: earnest money deposits, inspection costs, and closing costs. And I break those 3 things up because they're common misconceptions. So the earnest money deposit is your deposit that you put down to show the seller that you're serious when you're putting that offer in. And sometimes in California, that can be 1% of your purchase price. Now, there's no standard amount. You can put anything you want on the contract, but 1% is kind of the norm in California. So in California, we also have pretty high purchase prices. So 700,000, 600,000 is a normal number I see. So $6,000, $7,000 right off the bat when you get in contract is going to sit in escrow. We talk about inspection costs, roughly $1,200 out of your pocket up front. And then at the end of the loan, we're going to have closing costs. Now, closing costs are a makeup of lender fees and title fees and escrow fees, recording fees, and all of the stuff that goes to put the loan together. Those fees can range from about 2 to 3% of your purchase price is a really good estimate. It's not an exact science. Title companies are different. Lenders are different. All kinds of things range in such a big state. But that's a really good estimate of what I tell my clients that they might need cash at closing. Now, I kind of circle that back around and say, hey, the earnest money deposit, whatever you need for closing, that earnest money deposit goes toward that. So that money's not gone, but it's going to go towards those closing costs at the end. So whatever the balance is what you're going to have to come in with.
And that's a big question that comes up often in the group. Someone's always asking, hey, why is my realtor asking me for a deposit? I don't have to make a down payment. I've probably seen it 20 times if I've seen it once in there. Or they're saying, well, hey, I'm making this deposit. Where does that money go? When do I get it back? In the current market, for several years, we didn't know what seller credits were. So you were coming in with that money. But in the current market, you may get it back. The seller can cover your closing costs, but it is an important piece of that to know that is what lets the seller know you're serious. And if you're buying your brother-in-law's house, maybe he takes $500 or $1 or whatever that number is. For you guys in Wisconsin, what's a typical earnest money deposit?
I would say I see anywhere between about 1,500 and 3,000 is my average that I've been seeing on most of the loans. You get up into some of the higher loan amounts. I have seen some 5,000s, but we don't really see the $7,000, $8,000 in Wisconsin.
You guys are lucky, and especially, I mean, Lindsay, you're here in California. For
Yeah.
I loan throughout the state of California, or lend throughout the state of California, but for our Southern California clients, high purchase prices, and these listing agents are getting aggressive, like giving instructions. One of my agents showed me
Yeah.
a client was putting in two different clients putting in offers, and they got a full one pager from the listing agents of exactly how you were going to write your offer if you wanted your offer to be considered, and both of those said 3% deposit, period, end of story.
Yeah.
They didn't, they weren't asking, are you going VA, what's your down? They just said, hey, 3%. And for us in California, there is something magic about 3%. In the California Association of Realtors contract, there's a liquidated damages clause that says above 3% is really all they can get for liquidated damages. So if there's a dispute, you're the only thing you have at risk is up to that 3%. So for us in Southern California, at least in the competitive areas, which the interesting thing, what's the most competitive part of the market right now? For us, it's first time buyer stuff. The higher end stuff isn't quite as competitive, but still a lot of people looking to get into the market. So depending on where you are in the country, your realtor is not being crazy. They're not trying to tell you you have to put something in there that you don't. And as you can see, a big variance from Wisconsin to California, somewhat of a variance from parts of California to other parts of California. So rely on your real estate professional. If you are having questions about it, by all means, throw it in the forums, and we'll moderate and go through that. So
I want to say one thing on that, if I can, Josh, really fast,
yeah,
because you kind of mentioned that in some of the higher, more competitive areas, those deposits can be up to 3%. And I have absolutely seen that in the Bay Area. I have a lot of Bay Area clients, and I've seen deposits that were hundreds of thousands of dollars, which sounds crazy to some people. But there is no, in California at least, it has to be at least $1. And I actually ran into this with a VA client, and they said, I already made kind of a for sale by owner kind of situation. They said, I already made a deal. I only want to put $1 as a deposit so that I have a real contract, because that's what the law says. So what's normal and typical in your area doesn't always have to be. So yes, it's normal, but you can put something other than normal. That might be a little bit of a controversial topic, but it is okay.
well, think about it. Doesn't it really come down to leverage? So 2 years ago, if you had walked into a seller and said, hey, I would like to make a $1 deposit, they would have laughed at you and told you to get out of their house, because I've got 47 people who want to make a 5% deposit. And in the current market, you can ask for anything you want. I mean, would you guys agree with that statement? You can ask for whatever you want in the contract. You may or may not get it, but asking the question is never a problem.
Well, Josh, my company's licensed in 16 states. Okay. So we
Yep.
lend in 16 different states. And what I find is most of the states are that 1% rule. It's not a statute, it's not a law, but it's a benchmark or a guideline that we're finding in most of the states. The other thing to go with what Lindsay said, if you have a seller and a buyer where there's a relationship and they discuss it, $1 is going to work. Most times, though, when a veteran says, I don't have to, I don't want to, the seller is not going to accept $1 type of a situation unless it's a pre-negotiated type situation like that. So you still want to put good faith into this. You want to show that you're serious. And as Lindsay pointed out so eloquently before, that money is going to be used for other things down the road. Or in some of the states that we lend in, sometimes we have the veteran get a check back at closing. It's like they get a refund after they sign all their paperwork as well. But you have to show up front that you're serious about buying a house.
And that really is the purpose of the deposit, that you have some skin in the game, that if something goes sideways, you don't just go, I'm going to run down to McDonald's, I'll catch you guys later. You literally have something at risk if there is some sort of dispute between you and the seller. And that's why they do want a real number, not just a nominal number that does create a valid contract. So from that perspective, Matt, what I kind of want to go down this direction. Closing costs. There's closing costs, and when people think of closing costs, it's how much money do I have to come in with at closing. But there's two different types of closing costs: non-recurring closing costs, and then there's prepaids or recurring closing costs. Why don't we start with non-recurring? Can you walk us through what that is, what falls under that group, and what a veteran or non-veteran borrower can expect to pay in terms of non-recurring closing costs?
Well, I mean, there's like closing costs, like I would say things that you can shop for. Is that the ones you're talking about? Like the ones on the loan estimate? Is that
Yeah, yeah.
okay?
So we look at the left side of the loan estimate: box A, box B, box C.
Okay. Yeah, so I mean, there's certain fees that you're going to start with. Maybe let's just start with box A. When you look at your loan estimate, you're going to have some lenders charge processing fees, some lenders charge underwriting fees, and those are I generally see about $1,500 in most cases. I know a lot of the lenders in vetted VA that we waive those fees, the processing and underwriting. So those you don't generally see. The biggest fees I generally see in box A are discount points.
Walk us through that. I mean, it's a confusing thing, and
Sure.
it can be confusing because some lenders use that as a sales tactic of confusing people, because you see it not only as discount points, origination fee, any
Sure.
number of things that it can be called, a broker fee. I've seen it. And speaking of box A, I saw one of the craziest things I've ever seen. You're saying, and pointed out that a lot of times in this group, it's going to be waived. You're not going to have those at all. I saw a box A fee the other week of $200 for an Encompass technology fee. The broker felt that the borrower should pay for the technology that they utilize to process the loan. So that one
Wow.
was first time I'd ever seen it, and I about fell off my stool when I
The
saw it.
borrower
But
pay for their bad technology.
I
the
believe
terrible
that's
technology.
junk fees, they call those. I believe
Yes,
that's what they call
that
those,
would be a junk fee. But with that, I didn't mean to distract from the actual question. What are points? They're going to show up there in box A, but what are they? Why would someone want to pay them or not want to pay them?
Sure. So a discount point. So sometimes in the market, I've seen where it really does make sense to pay, a discount point to get maybe a lower rate. For instance, sometimes I've seen it where paying just maybe $1,000 in discount points can save you maybe 0.375 to 0.5% in interest rate. So what you really want your lender to do is kind of break that down for you. So if you pay that $1,000 in discount point and it saves you $60, $70 a month in your mortgage payment, you really want to have the breakdown to know that maybe in 9, 10, 11 months, if I pay that discount points, the savings that I'm going to have on my mortgage payment will recoup that dollar amount. So that's really what it is. You're kind of almost hedging yourself against, hey, maybe the rates won't go down, and that this might be the lowest rate you can get for a while. So when I charge clients discount points, it's generally saying, you're probably not going to be able to refinance for 6 months to a year. So let's just, kind of keep those discount points, at a year or less.
I like that. When I'm going through it with clients, what I like to explain to them is there's not just one interest rate. On any given day, there's a whole list of interest rates, higher and lower, but there's a par rate, a rate that the lender would like to get. They're not going to pay you for that, and they're not going to require you to pay for that. So points, either in the form of a credit to you or a charge to you, are just a yield adjuster. The lender is looking for that par yield every day. They'll take less, but you're going to pay them some more upfront. They'll give you some money to cover your closing costs, but they want more every month in the form of higher interest. So just like Matt said, what you want is your originator to go through with you if they're proposing that it might be a good option, that break even is short enough, to show you a couple of different options: 0 points, a lender credit, paying points, and showing you what that break even is. It's pretty simple. We've all got nice software that will show you that, and you can make that determination.
And
Yeah,
that's
and I always
important,
tell people
Josh.
too, it's closing costs and rates are kind of like a teeter-totter. One goes up, the other one goes down. So you can kind of just keep that in the back of your mind that, if you want a lower rate, you're probably going to have to pay a little bit more in discount. So it's a good way to explain it to make everybody understand.
You were going to throw something in there, James?
I was just going to say, specifically to the VA loan, it's important that the return on the investment, or the ROI on those discount points, is considered when the veteran has to PCS, or maybe they're getting relocated and they don't want to keep the house as an investment property, they want to sell it. So if that return on the investment of exchanging the cash to get the lower rate, you get a lower payment. But as Matthew said, there's a time where you have to keep it so long to get that money back. If you're planning on not keeping that house and you're going to be PCS in 3 years, make sure you factor that into the equation, because it might not make sense for you then to pay discount points if you're only going to be there for 3, 4, years, depending on what happens. So.
There's another point that I want to throw in here, and you guys feel free to agree, disagree, push back on this. I tell people, I don't care what's in box A. You can even have your crazy Encompass technology fee in there. I truly don't care. You can have 0 items listed in box A. You can have 14 different items listed in there. As a borrower, the only thing you need to do is add all those up, and the loan estimate actually does that for you. It puts a total for box A, and those are the points that you're paying for that rate. So here's my rate. Here's what I'm paying for it. If you want to compare to another lender, the other lender may have nothing in box A and they have a higher rate, or they have the same rate. If you're sitting there and comparing to, I think some of these fees that lenders like to charge, junk fees, weird names, and tons of little fees in there are silly. But at the end of the day, they're all points. You guys agree with the premise there?
Yeah, absolutely. Everything in box A is essentially what you're paying for that rate.
Because those are the fees that go to the lender, either directly to the lender or the broker. So someone who's making the loan, we're brokers. I think all 4 of us are brokers. We send the loan off to the lender. So some of those fees could be to the lender, and that's what they're wanting for offering that rate. Our compensation is all accounted for in there in box A and the rate. You're gathering everything. You're gathering everything in there.
Absolutely.
And I think what go along with what Josh is saying too is I've seen some loan estimates, I reviewed them, where they didn't have a lot in box A, but then box B and C were just so large. And, you know, a lot of times it'll be the lender owns the title company. Well, now all of a sudden title goes from $700 to $1,400. Well, you're still paying those fees. So you really have to be careful when you're comparing that not everybody shops around to get you the best title fees, you know, or you might have a credit report fee of $300 instead of $62 or something like that. So you really want to compare. I think A, B, and C is probably the most important ones to compare.
Well, after January 1, isn't $300 what the credit bureaus charge for credit reports now?
Pretty much, yeah.
Just feels like it.
Yeah.
Just
I have a quick question just for people following along, and for anyone who's not familiar with what we're talking about. All these boxes, A, B, C, D, the alphabet, are from the loan estimate. And if you're looking at a loan estimate, I don't know if we have an example of one, but if you're looking at a loan estimate, the difference between non-recurring closing costs and recurring closing costs, which we're going to explain shortly. On the left side is ABC. Those are your non-recurring closing costs. On the right side is EFGH. Those are your recurring closing costs in most cases. The only box that's the exception to this is other costs down at the bottom. So not sure if we have an example, but if anyone following along, like pretty easy, like left side, right side. Non-recurring, recurring.
We've got one of these fun ones right here. So it's not the greatest here in terms of presentation on the screen, but let's get to page 2. So this one is completely empty. So there's nothing in here. But box A are the origination charges. Like we said, everything goes to the lender or the broker. James, Lindsay, either one of you kind of want to walk through box B and box C. Again, they're still closing costs. They're still costs that we're paying, but who they go to and what is the difference between a service you can't shop for and a service you can shop for. And then I kind of also want to ask, is that really true in a purchase contract, or in a purchase transaction, or have we already agreed to most of those services that show up in box B?
Lindsay, you want to take B and I'll take C?
Sounds good. Right. So let's answer Josh's second question first. In a purchase contract, box B and C can't really be negotiated, only in certain cases. And I'm only speaking to California. In California, most of the time, the seller chooses who goes in box C. So not negotiable in a lot of the situations. But box B.
Lindsay, at least at the point when we get an executed contract, it's already been decided. If you look at that, so you're seeing the loan estimate after you've negotiated your contract for the most part. And you had that negotiation. You did have the right to shop. just like a seller can take a $1 earnest money deposit, they may work with your escrow and title company, but it's a negotiation. It comes down to leverage. In the current market, sellers still have a lot of leverage, and it's unlikely to work out that way. It's possible, but it needed to be done before we get to the point of us having a contract and sending you your loan estimate.
Yeah, and there's a lot of real estate agents in California that don't even give you they don't even tell you about that. And yeah, it can be negotiated, but as long as I've been in this industry, I've been doing this for a long time. I'm not going to say how long because I'll age myself, but I haven't seen, I mean, I've seen very few cases where a buyer has negotiated away from a seller's title company, because a lot of the times escrow is already pre-opened.
That might be more California specific though. So speaking to a national audience, I've seen a lot of times where that is actually not the case from where we lend money. So where the buyer does have the right to do that. So,
and that's across multiple states. James, you're not, like you said already, you're not in 2 or 3 states. Your company's in 15, 16 states. Yeah. So it does vary. So a lot of tonight's conversation, I wanted to make sure we were super clear about that. This does vary regionally. You know, some areas you see really high title fees and a tiny settlement fee. They're wanting the title insurance and they'll do the settlement really cheap. Other areas they're more similar, or the title's really cheap and the settlement is expensive. So there is no right or wrong. It just regionally it is what it is. So kind of why we're talking through this is hard. This is hard. You're not an expert. You don't do this all day every day. When one of the 4 of us sees a crazy loan estimate, you look at it and something jumps out like a red thumb. Most borrowers would not know what's weird or strange about it. And again, I get this all the time. I do a big YouTube live with one of my realtors, and we get people from around the country, and someone will send in a loan estimate, and I'll look at it and I'll go, that is nuts. And I'll call one of my friends in that state, and they're like, that's not nuts. That's just how we do it here. So regionally, there are a lot of differences. But to get back to box B, Lindsay, I didn't mean to cut you off on that.
No, it's okay. We kind of went on a side skirt, an important one, that, you know, regionally and state to state, these can differ. So box B, you're going to see fees like the appraisal fee, credit report fee. You could see things like flood cert, MERS, which is Mortgage Electronic Registration System. And then you can see some other things. Maybe you have a reinspection fee for your appraisal. That means the appraiser had to go back out. Tax service fee. These are just an example of some of the fees you might see in this box. Now it says services you cannot shop for, because these are service providers that we actually choose as the lender or based on the loan type. For VA loans, we order VA appraisals through the VA portal, and then they select an appraiser at random. Those fees are set by the VA, and they're per area. Loan officers should be able to provide what your fee is in your area. Credit report fees are whatever your lender, your loan officer charges, and it's the actual invoice of that fee. We cannot charge any more than the actual cost of that report. And as we mentioned a little while ago, as of January 1, they got pretty pricey. They went from about $35 to $75, and sometimes they can be upwards of hundreds of dollars now. You know, if there's 2 people on a loan and there had to be some, you know, work done or anything like that. Flood cert, MERS fees, those are all pretty nominal. They're all usually range in between like $8 and $50. Reinspection fees, again, it's per the appraiser. So yeah, these are not fees that you can necessarily shop for. These are all service providers that we choose.
And both box B and box C, a point that I always like to make clear on here, for the most part, not only are they not things that you can shop for, you don't need to consider them when you're looking from one lender to another on a purchase transaction, because most of this has been negotiated as part of the contract. It's going to be the same whichever any one of us 4 does your loan. Everything except for box A and the rate is going to be pretty much identical. Yeah. So with that, James, you want to walk us through box C?
Yeah, just to finish up with Lindsay's thought, though, the VA funding fee, which is important in this context, this conversation.
Oh, thank you.
On there, yes, in box B.
I completely missed that, but yeah.
You've done a brilliant job, though, Lindsay. Your explanation was very good. Thank you.
Thanks.
So C. So this is going to vary by location. So services you can shop for. So my corporate office is in Wisconsin. Just to give you an example, in Milwaukee, Wisconsin, the buyer can choose wherever they want to close and shop around. In Madison, Wisconsin, which is 60 miles to the west, it's written in the contract, and you go where the seller tells you to go, or you have to negotiate it out of the contract. And that's 2 different municipalities, 60 miles apart. Furthermore, Wisconsin borders Illinois and Minnesota. The closing costs in Wisconsin are significantly lower than the closing costs in Illinois or in Minnesota. Think about that. So we're not even going all the way to California or Connecticut for that. We're talking right here in the Midwest. So it really varies by location. But the thing that you can shop for technically, or the spirit of this, if it's not written into the contract by the time you get there, so pay attention, make sure you talk to your real estate agent. You want to work with a vetted VA professional who understands this very thoroughly. But there's things like title insurance. There's things like surveys, depending on location. If you're in Texas, you got to have a survey. There's things like an abstract fee. If you're in Minnesota, like, what's that? I don't need that in Wisconsin. Then there's a title insurance fee. Then there's a settlement fee. You got the person who does all the paperwork, that company is a fiduciary. So all the money gets wired to this title and escrow company. And then you want to make sure that they're not taking your money and going to, Sweden or Switzerland with your money. So they ensure that all this is going to be handled properly, and they charge something to do that. And there's different companies that do that, have different models. Some states regulate those models. The insurance commissioner gets involved, says, hey, we're going to regulate how much money you charge because it's an insurance policy. Other states don't do that. This is why it's very important that you work with a seasoned professional who knows what they're doing, who can navigate you through this storm. I like to say it's like your dream team. You want to have a great real estate agent, and you want to have a great loan officer, and you got to have good chemistry with them, and they have to be experienced and knowledgeable in this because you're talking a lot of money. And as you navigate through this process, people who are experienced do this every single day. You might only do this once every 3 years, 4 years, or 5 years. I'm like, oh, what was that? I remember that one lady, Lindsay, she explained it so well, but what was she saying again about that? What was that technology fee? Why do I pay that? Or what's this MERS thing? So I want to just encourage you, ask questions along the way. Just don't sign it. A lot of these documents come with you just click and electronically sign it. Slow down, read it, ask questions, and make sure that your loan officer gives you an excellent explanation, and don't sign it till you understand.
That was awesome. And before we on the topic of questions, and before we transition over to the prepaid side, the other side of the loan estimate and walk through that, we actually have a couple of good questions here. One I wanted to hit first says lender credits are not reflected in box A, right? That is correct. Up here in box A, it's just totaling what all those charges are. And we get over here to the other side, but you'll see down there in box J, lender credits get listed there and they will offset. And that one is always a fun one. I don't know if you guys ever see loan estimates come across your desk where someone is paying points in box A and then getting a credit down in box J. And it always confuses me how and why a lender would actually charge points to just turn around and give a credit. But we see it a lot, and it seems to be for the most part just some fun and games. Now this one, I would love to hear you guys feedback on this one, and I don't like this. I'm gonna take this down for a second because we had Lindsay, you were hidden behind the comment down there. We have a couple more good questions here. So how will I know if my lender is telling the truth about discount points if I pay the money for discount points? So with that, what do you guys thoughts? What's the best thing for a buyer to do in terms of making sure the discount points aren't just extra profit to the lender? And I guess another question for you guys, can a lender do that? Can a lender just throw a couple of extra points in there in today's day and age and just make extra money on that loan? James, you were shaking your head. You want to walk through that one?
Sure. So no, they can't do that. All right. So there's this thing called average prime offering rate. All right. So when you're looking to buy the rate down, you have to have, here's the benchmark rate, and you have to have a reason to go under that rate. That's the simplest way I can explain it. And that reason to go under it could vary by different companies. So Matthew's company may have a different model where it takes them less money. They can run on a thinner model than Lindsay's company. Lindsay's company say, hey, listen, we have more staff because we give a Ritz-Carlton experience, but that staff's got to go somewhere and it gets put into the interest rate. Matthew's like, hey, we're going to try to give Ritz-Carlton, but we're charging a Hampton Inn budget over here, okay? So his is a little thinner. So that could vary by that, but you just can't say, hey, I'm going to make a little extra money because I got somebody who doesn't understand it, and I'm just going to charge him points. No, there's paperwork that's got to be filled out, and it's all got to tie out. The model, though, varies by the lender. So even if you have a rate with points attached to it, I would still encourage you to get a second opinion to basically fact check or truth check your current loan officer to make sure you're not getting ripped off. And it isn't because they're bad people. It's because one may just have a more expensive way to do loans, and one may manufacture the same loan on a thinner margin. I may be happy driving a Chevy, and Matthew may say I'm driving a Bentley, and there's a cost for that. So that's why.
And I don't think it's necessarily a truth check, because as you perfectly explained, we all run on different margins. We all have a different company structure. And this goes for all lenders, vetted to vetted lenders, and lenders outside of us as well. We all have different company structures, different margins, different, expenses. So the points
You are correct.
can't just
Forget
be
the truth
added. But I think shopping, getting at least 2 estimates, even between 2 very honest people, you're going to see different numbers most of the time. So
yeah,
it's good to protect yourself.
This is the funny thing. I joke. I do a lot of these lives, and when we're talking and people ask this question, I say, listen, you have to get at least one quote. Otherwise, it's like marrying the first person you go out on a date with. They could be the greatest, they could be the worst. You have no idea. You need at least one point of reference. You don't need to go out and date 50 people, but you need at least one frame of reference to know where they're at. And I was going to save this question for later, but I would love to get you guys' opinion on this. I don't think that we said to compare between 2 lenders. If you get a quote from all 4 of us and you look at the interest rate and the points, now the reality is all 4 of us have been vetted. We're all pretty good at this. We're experienced. We're not new kids that have been doing this for 6 months. So you're going to have a very good experience with any of us. So maybe you could just narrow it down to which of those 4 great options is the cheapest. But I like to tell people, be very, very careful if you're picking off of who has the cheapest quote. I get people all the time. We see this in the forums all the time. Hey, I got this quote. Do you know where I can get a lower one? Can I get a better one? Will someone beat this? Or, hey, I got this number. Can you beat this? And I say, do you want me to? Because if going back to the whole Hampton Inn, Ritz-Carlton, there are places that will quote really, really low numbers. Maybe they deliver on them, maybe they don't, but they also aren't delivering the world's greatest experience. So I like to say there's 3 pieces that you need to be judging on. Hopefully you've dated at least 2 people and you make sure that you're getting good terms, if not the absolute best. You want to have knowledge and expertise. You also want to have rapport and a comfort level with that person. I might be a great loan officer, but you and I just don't connect. We're going to be working together very closely for 4 weeks, 6 weeks, 8 weeks, 12 weeks. It is important that you're comfortable, free to have open conversations with them, that you don't feel like they think you have dumb questions or they don't have time for you. So that's just rapport and people skills and how the 2 of you get along. You want to make sure they're an expert and can explain the things that these guys have been going through tonight. And the terms are important. We're in a day and age where anyone can get on the internet and compare fairly easily. But what do you guys feel about that? How do you advise when we get these comments of people saying, hey, how do I get the absolute lowest rate and fees on my loan?
Well, I agree with you. The lowest rate isn't always the best option. I think I've got pretty good rates, but at the same time, there's always someone out there that's willing to undercut me. And I don't know if they're going to do the best job. I don't know if they're going to serve my client who I care about, to the highest and best of my ability. Because it's the cheapest, right? Like if I go to Denny's, I expect Denny's. Yeah. If I go to the steakhouse, I expect a different class of service. So sometimes you get what you pay for.
Yep.
Matthew, what were you going to say?
One thing to look at too is really when you're looking at the discount points is when you're shopping from lender to lender is you got to make sure that you're shopping that same day too, because one day a 6%, let's say, you might only have to pay a half point for, and then the next day it might be a full point for that same rate. So if you wait till the next day to get a quote from somebody else, they could be quoting you different, rates because maybe the rates got better that day. So you really have to make sure when you are shopping that the rates and closing costs, do everything that same day. Ask them maybe, hey, how's the market going? Is there a lot of fluctuations today? Because you just really never know. In the morning, the rates might be really low, and then by the afternoon, they could have increased, an 1/8 to 1/4%. So it's really important to shop the total rates and closing costs in the same time frame.
brings me right back to what Lindsay said when she was talking about Denny's and the steakhouse. So I just tell people, and I tell my staff the same thing, the sweetness of a low rate is long forgotten after the sourness of poor service. So just remember that. Sometimes the sweetest thing is sour in the end.
That's a perfect analogy. I'm going to go write that down.
I was going to say, you can tell we're in a group of people that have done this for a long time. We've
Yes,
been through this and have had a few things. So my friend Shay, who actually found us through that other live that I do on Wednesdays, veteran, he's been here most of the last few weeks, has a couple of good questions here. Last year during this time, I had a realtor and lender tell me if I wanted to use a VA loan, I'd need to put down more earnest money. Why would a lender and realtor be trying to tell a veteran that their hard-earned VA mortgage benefit was going to cost them a larger down payment? Anyone want to take that one?
This comes down to two things, to put it very simply. Last year was an insane market. Okay. Different areas demanded different things. In my area, a large earnest money deposit meant that you were really serious about buying that home. And if you were a veteran using 100% financing, the seller wanted to know that you had money to cover appraisal gaps, repairs. They wanted to know that you weren't going to ask them for anything, that if anything did come up, that you had the money to pay for it. And it could have come out of that earnest money deposit. So that's number one. That is most likely the answer to that question. However, it also could have been lack of education on the real estate professionals' part in understanding how a VA loan works.
Anti-VA bias is real, and
Yeah.
we actually have done 2 separate shows on it. If you go back through the archives of how to work around it, while we were in the middle of that market, it was very important. And we did one earlier this year. It's a slightly different market, but it is still important. There are agents and other loan officers that don't understand the program, don't understand the benefit. It's more understandable when a realtor out of ignorance would try to sell you away from the program than a lender out of ignorance trying to sell you away from the program, because it is pretty darn rare that you would ever find a situation that the VA loan is not the best for a veteran. It happens, but it's pretty rare. It's not nearly as common as we hear the stories of people having an officer trying to sell them off of that. Now, we actually have a follow-up from Shay. Lindsay, you and I are going to sit this one out because this is a Wisconsin specific question. Last year, the company I was going with had me get my own inspection. Was that a lender thing? It was in Amory, Wisconsin. I'm so glad to have found this place. Thanks, Josh. Like I said, it's funny. He found us on the other live. We found out he was a veteran. We had mentioned the show here, and he's been joining us every week and asking some good questions. So any idea, any of our Wisconsinites, how is that? Wisconsinians, what are you guys?
Wisconsinites.
Wisconsinians. So yeah, I'm not sure which inspection he's talking about. I mean, because there's a pest inspection that kind of the southern part of the state is required to have. Then there's the appraisal, which all of Wisconsin would need. And then the home inspection, it just is not required. So I'm not sure exactly which inspection he was talking about. But, generally the lender would order the appraisal, and then the other inspections would be ordered through them.
And if it were a home inspection, I mean, it's rare, but I've seen realtors that are like gun shy. They'll give you like 10 names, or here's a list of 10 home inspection companies. They don't want you coming back and yelling at them if something comes up on the inspection or after the inspection that you weren't aware of. So that's the only thought that I have on there. We also had a comment. I'd love to throw this one up here. The the cost of title depends on who pays it. In my humble opinion, it should be on the seller. I usually open title early to make sure nothing comes back. So I'm thinking our user here is a realtor. Oftentimes, a realtor, when they get a listing, they don't want to get blindsided by something on title later on. They'll start the title.
Let me talk about that, Josh.
Yeah.
Let me share about that. That's an excellent point. All right. And I'm going to tell people why, because anything we share with you today is something that's happened in the past. So a good real estate agent should open that right away to find out if the seller has judgments or liens against the seller. Give you an example. We had a client who was buying the seller's house, and the listing agent did not do that. And I kept asking for it. What ended up happening was The seller had $100,000 tax lien on the house, couldn't get it released, and our client was homeless because the real estate agent did not do that. So a good real estate agent will check that on the seller side to make sure that they can convey title over to you. If they're upside down on the house trying to sell it, it's going to be a mess for the buyer. Excellent question.
And where we, used to see it a lot, it's been a long time since we've been past that 2008, 2009, 2010 economy where we had a lot of people who were homeowners who had a bankruptcy. And so they had a first and a second mortgage. Those were really common. HELOCs, 80-20 purchases. So they hadn't made payments for 10 years on their second. Doesn't show up on their credit report. No one had asked them a peep about it. And so they go to sell their house and like, no, that was in my bankruptcy. And like, well, kind of. It was the ability to collect was wiped away in the bankruptcy. Your security in the home was not. So we could probably go on and on. There's probably 4, 5, 6, 7 really common things that pop up of liens that sellers are not aware that they have. So it is very important that they're doing that up front. And that's a lot of the time when the listing agent has already gone through that, they've had their title company doing work, they're going to fight to have that title company get the insurance. And for the most part, to an end buyer who's getting an owner's title policy bought for them, it's transparent insurance. I love to ask this question, so I'm going to see if I can get any of you guys to answer in the affirmative. Do any of the three of you, in all of your years of doing loans, have you ever known about a title claim that paid off for one of your buyers or even someone that you're aware of?
Like after close?
Yep.
Using title insurance to pay a lien?
Yep.
Yeah. Me.
So
for myself.
And how much was it?
It wasn't fair. I mean, it was $4,000. So it was a fair amount.
They're very rare. Title insurance is profitable because claims are very rare, but the claims that are expensive. $4,000 is a little one. And it's funny that you said that you were the one, because the one that I'm aware of, I was the owner on one. And what happened is it was a 4-unit building. It was illegally converted to condos. All of the documentation that was recorded in title was fraudulently done by a prior title company 15, 20 years before. And what happened was the title company had to pay, it's like $100,000 to go back through the city, pay an impact fee, do all of it. So when it comes through, it's expensive. So title, we could do probably a whole show on it, what in the heck it is, why you want it, and why it's important. But it absolutely is.
Yeah, I recommend it. When clients ask me that question, I give them my story. It was my very first house. And it was my very first house. I was 18 years old. And 3 months later, I get a garbage bill that was $4,500 from the county.
That's a big garbage bill.
And at 18 years old, I was like, oh my gosh, what do I do with this? And of course, my mom is like, that's not yours. It's the old owner's. And so I called the title company, filed the claim. They paid it.
Let's get to the boring side of closing costs. And again, I'm going to go ahead. Let's get this question out.
The recurring side is that's the exciting side.
Well, it might be exciting, but it's mundane. We don't have 47 different line items and different things that people don't know what they are. So I'm trying to get back here to my screen. All right. So since Lindsay, you are so excited about these, why don't you walk us through your recurring closing costs, also known as prepays? These are things that you're going to prepay. So technically they're closing costs. You pay them at closing, but we call them recurring because they recur. You're going to repay them, or you're going to continue to pay them over the life of ownership. You want to walk us through that?
Yeah, I'll walk through just kind of the whole thing because it's pretty simple, and then maybe you guys can just add anything that I miss. So box E is taxes and other government fees, recording fees, transfer taxes. That's pretty much all I see in this box. Do you guys ever see anything else in that box in your states that you're approved in?
No, same thing. And to me, this irritates me that it is on the right side. The right side truly is recurring items. Those don't recur. We pay them at closing. It should be a closing cost, and it should be on the left side. It's not a loan cost in that it doesn't get paid to the lender, but neither is title insurance, neither is the settlement fee. So to me, every time I see it, it's a pet peeve of mine. I'm like, get box E over on the other side because it kind of throws this off.
And we have plenty of room. Like it can fit. They could have put it over there. So yes, just taxes and other government fees, anything that your county charges to transfer from the owner to you is usually what's in this box. The next is prepaids. Prepaids, homeowners insurance, mortgage insurance premiums, usually not applicable on a VA loan, but it could be on other loan types. Prepaid interest and property taxes. Sometimes there's tax prorations and other things in this. These are your fees for your expenses, your prepaid interest. That's the interest from the time we close the loan to the time of your first payment. Your homeowner's insurance for the first year. Again, mortgage insurance, not super applicable on VA loans, but it could be on other loans. That's usually about 3 months that are charged if that's applicable. And then property taxes. Again, that's going to be a tax proration based on when you're closing versus when the tax bills are due. And the title or escrow companies do those calculations. The next box is initial escrow payments at closing. Now, this is what we're going to put into the escrow account that's going to pay future bills when they come due. So homeowners insurance, because we collected a full year premium above, we're only going to collect 3 months in this box. We need a little bit of a buffer because it might be 2 months or 1 month before you make your first mortgage payment. So fast forward 11 more months, and we've got enough in the escrow account to pay that homeowner's insurance bill when it's due. The same kind of proration happens with property taxes. So that box is going to be dependent on when you close and when your next tax bill is. It ranges anywhere from 3 to 9 months, depending on the time of year you close and when your bills are due. So sometimes those boxes, if you total up the boxes on this side that are just your prepaids, sometimes they can be equivalent to what's on the left side of the page. It just depends on how much your taxes and insurance are.
Yep.
Anything
Unless these guys caught and caught something there. But what I always like to say on this, the number one question that I always get is, well, they see in box F homeowners insurance, and then they see in box G homeowners insurance. Why are you charging me twice for homeowners insurance? You did explain that. Just want to make sure for you guys watching at home, the one is the first year's premium. The other is getting enough in that impound account to pay it at renewal. So you're not getting charged twice. Same thing with the property taxes. Are they the same thing? Yes, but they're kind of accounted for in a different way in those two boxes.
Mm-hmm. Yeah, one we have to pay, we have to pay part of it up front, and then we have to collect a little bit so that we can prepare for bills that are due in the future. And that money is going to sit in a little account. You'll see it on your mortgage statement. That's really your money. It actually, the servicers, the people who you pay your payment to every month, they actually have to hold it in a non-interest bearing account. And if it is in an interest bearing account, you'll get little tiny checks for 56 cents randomly throughout the course of your loan. The next box is the lovely other box. In other, you might have that title insurance that we were talking about earlier. You might have things like home warranty, natural hazard disclosure statement. That's all I can really think of that goes in that box. Do you guys have anything to add?
Typically, that's what we're seeing.
Owner's title, the owner's policy.
Yeah.
Paying, but they disclose it there.
Generally don't see too much in there.
Yeah, home warranty is the other thing that I see in there. So those are going to be usually things that are optional. So owner's title insurance is technically optional. Natural hazard disclosure is usually on purchase contracts, and it might not be applicable for your state. It's an optional thing here in California. And then home warranty, again, optional. I do recommend get a home warranty for the first year. You know, there's pros and cons to home warranties. I say it's a cheap enough insurance policy for the first year. I had a quick story. I had a client, first-time home buyer. I work with a lot of first-time home buyers. First-time home buyer. We had an unprecedented cold front come through, and they lived in the foothills. 2 months after they bought their house, their water heater exploded because of the cold. Full on exploded, broke the door to the water heater little closet. Home warranty covered it and replaced it, and ended up replacing all the pipes that froze and exploded underneath the house.
Nice.
But a fun fact about home warranties, since I'm talking about it, home warranties typically do not cover anything outside of the foundation walls. So fun fact, and a lot of people don't know that.
So make sure there's nothing valuable outside of your foundation walls. You don't have a wonderful above ground jacuzzi or something sitting out in the middle of your backyard.
The biggest thing that I've had come up quite often is sewer lines. Your sewer lines are outside of your foundation walls. They're not the county's responsibility, and they're not the home warranty's problem. So if it runs from the outside of your foundation wall to the street or to wherever that hooks up, and you have a blockage, a tree, anything, a break, be prepared for that gigantic cost. So moral of the story is have a sewer scope done before you buy a house.
So with everything there that we covered non-recurring, recurring, all the fun stuff. We talked earlier, box J there, we'll have lender credits. So if you're getting a credit to offset any of those charges, it will show up there. And then the nice dark box there, calculating cash to close. To me, that's by the time you get to the loan estimate, you're kind of committed to the transaction. So hopefully your loan officer up front going through the process, as we said, told you, what do you qualify for? What's the monthly payment, and how much is that cash to close going to look like? And you can see it's somewhat complicated. A good loan officer should be able to get you pretty darn accurate. We can't get that dead on. There's a lot of variables, a lot of things that move, a lot of things not inside of our control. So know that your loan officer is likely to pad a few of those things to make sure you don't have an unpleasant surprise when it comes to closing and you have all of your funds. I had a borrower call yesterday that he told me that his lender did not told him that it was $26,000 in closing costs in addition to his down payment. So they were having to put off closing 3 weeks while he found $26,000. When I hear questions like that or hear stories like that, it blows my mind that it happens. So I think for me, the most important thing out of all of this, make sure that you're going through that with your lender up front. Because a lot of times they'll say, hey, you're approved for $500,000. The payments, $3,250 all in. You good with that? Cool. Go find a house. And then we get to the end and no one has gone through these numbers. Am I the only one that hears those stories, or you guys get to come behind other loan officers that have not updated their clients on what to expect?
Every day. And we see it in the group as well. We hear about it, we see it, we review, loan estimates time to time and specific fees and stuff. And that proactive education up front is so incredibly important. And if you're not getting that, absolutely call somebody else, because you should be getting that kind of education and knowledge up front. People should be telling you how the process goes. You should know what your payment is, and it should be really easy to get, an idea of what fees are. I do want to say that in the beginning of a transaction, I'm not giving out a loan estimate. So if you guys want a closing cost estimate, we do a lot of things like fee sheets and stuff like that. We have to guess what title company fees, what a lot of those things, box B and C, are going to be before we actually have a contract. But we can provide you with one. It's not going to be the greatest estimate, but we can definitely give you an idea.
Lindsay, you said something really important, and I'm not sure that a borrower watching this, a vetted VA member would know or understand. A fee worksheet. Okay, cool. What's a fee worksheet? How is it different than a loan estimate? And do I still get the information that I need?
Yeah, it's basically the same thing. It's just a different format. To be quite honest, I think my fee sheets are easier to read than a loan estimate. A loan estimate is going to come after we have an executed contract, because it's actually a legal document. We're required to give one at certain criteria in points where a loan has been consummated. A fee sheet is a more casual version of a loan estimate when there isn't an actual contract in place.
So it's funny when it's more casual version, because my initial thought was, if you've done this long enough, before we had TRID, you had a good faith estimate, which meant you were trusting that your loan officer had good faith and knowledge and was capable of giving you those numbers. So this is a good test. You should get a fee worksheet up front, and it should fairly closely resemble your loan estimate. It's not going to be exact for all the reasons that Lindsay walked us through, but they should be pretty darn close. So if you are working with a lender and they give you a fee worksheet and the loan estimate comes as soon as you have a contract or within 2 or 3 days of getting that contract, and they're vastly different, it is a little bit of a red flag. Have that conversation up front and say, why were we off so much? What's the difference? Where did this come from? Box A
again. Box A. If box A is crazy different, red flag. Raise your hand. Ask a question. but the other ones are.
Box A, they're accountable to, but I will say, I will still go back, and I don't know how it is for you guys in other parts of the country, but Old Republic Title has a fee calculator on their website, and it is known for having the highest fees in the world. Like, I've never gone to the Old Republic calculator and had it not be higher than what the actual fees are. There are tools out there, where a loan officer can get the third-party fees and give you a worst-case scenario. But yeah, they're really only accountable to Box A, so those direct broker and lender fees related to your interest rate. You said something important there, and I think it's important for us to walk through. We're talking about closing costs, and we're talking about how do I know what I'm getting is right? How do I know it's getting disclosed in the right timeline? James, I can see it written all over your face that you want to walk through us versus old school good faith estimate. What's the loan estimate? When do we get it? And how does that relate to the closing disclosure at the end of the transaction?
I thought Matthew wanted to do that. He's been chopping it.
He's slapping you on the side going, no, this is my question.
Wait,
back off.
My internet's getting a little shaky here.
My connection's not good.
I'll take it.
Nice.
Hey, go ahead.
All right, so here's the deal. All right, so the reality is like she said, the good fees, the worksheet, it's just basically, hey, here's, rough idea. But the loan estimate happens when there's an application. There's 6 pieces of information that are required. When you have an application, by law, the loan officer, their company, is required to supply you with this document. This is a legal document, and it cannot be messed around with. All right. So what happens is, once that application is taken, they have 3 days to get this over to you, that you can review it and acknowledge receipt of that. The fees worksheet, it's just casual. Like, hey, it's kind of like you can write on a fees worksheet. It's just informational purposes only. But the loan estimate is legal, it's binding, and it's a very serious document, and it should be reviewed very thoroughly, and you should ask all your questions before you sign it.
We were focused more tonight on what goes on that loan estimate in those different boxes, but each one of those boxes has different tolerances. Box A is 0 tolerance. What they quote you when that goes out, if it's a locked interest rate, cannot change. The others have different tolerances that they can change, but it's not a perfect document. We quibbled where we saw some of the boxes, which side of the sheet they should be on, but it is vastly better than an honor system where we had some dishonorable people in our industry who would sort of game that system, and people had bad and ugly surprises at closing, which for the most part are completely prevented by the current system.
Yeah.
So we like to keep these about an hour, and we're running about 57, 58 minutes. So with that, I always like to go around the horn here and give you guys the last word on anything that you want to say, either related to tonight's topic and closing costs, or just loan in general that you would like Vetted VA viewers to know or be aware of. So Matt, you're stuck on the top row with me, so
Sure,
you get the honors. You get.
I think the best advice that I have as far as closing costs, and especially for some veterans, if they don't have a ton of money to bring in to close, or they really want that earnest money back, say they have all these grand ideas of things they want to buy in their new house, is to really maybe talk to your lender about possibly waiving your escrows. And where this can really come in handy is, so there's some lenders that force you to escrow your taxes and insurance. You don't really have a choice with a VA loan. There's other lenders that allow you to waive it, where on a normal transaction that could be that whole right side, in the whole section G could just disappear. And then say that was $3,000-$4,000 worth of prepaid items, plus you're getting a credit from the seller for the taxes from the beginning of the year until when you're closing. So like something like that, by just waiving your escrows, can really give you maybe all that earnest money that you put in back, or even, generally, more money than that. So that's just one option that I've been giving clients is, if they don't want to bring a lot of money to close, just have you waive the escrow payment, but know that you need to pay those taxes and that insurance when it comes due.
Yeah, it's a savings at closing, but it doesn't make the costs go away. You're going to pay them. You're
not.
just going to pay them later on down the line. James, what are your final thoughts on closing costs?
All right, so I'm going to give you a hack. Section F, F is in free. Oh, wait a minute, nothing's free in life. We know that. But in Section F, prepaid interest, that money, if you really want to entertain yourself, go out in the driveway and burn $100 bills, because that money is useless money. You want to get that number down as close to 1 or a negative number if possible, as best as you can, because all you're doing is wasting money on prepaid interest. It doesn't do anything for the loan. Nothing's free in life. So what happens is from the day you close, you go to the end of the month and then you skip a month. And the loan officers might tell you, oh, you get a free month. You don't get a free month. That interest is from the day of closing to the end of the month. You skip that month because we got to book all the paperwork. But when you make your first payment, interest is paid in arrears, like backwards arrears. So the interest you're paying for that free month is in your first payment, and then you're making a principal payment there. So to alleviate that as best as possible, get your prepaid interest down to 1 or 2 or 3 days at the most, and send yourself a treat. Take yourself out to dinner and celebrate how smart you are.
A piece that I like on that is just, it's again, I love talking about red flags. If you have a loan officer who's telling you, hey, if we close, on the 10th, then you don't have a payment for 50 days, just like James said, you're paying it one way or the other. There's no free ride. So manipulating that, and especially when we're in a refinance market, hey, you can skip 2 payments. You're not skipping anything. It's just, getting put on paper where you can't see and understand it. So I'm not saying that every loan officer that does that is shady. I'm just saying it might be a little red flag to pay a little bit closer attention if they're not fully walking you through what that means and just saying, hey, free money. All right, Lindsay, you get the last word tonight.
Okay. Well, mine's going to be more of a takeaway, because if you search in our group, my name and closing costs, I have explained this 75 times. And I think it's
Did you do it 75 different ways, or you go the same answer every time?
Nope, I give the same answer every single time. Actually just copy and paste it at this point. Closing costs. We get the question all the time. I don't have any money to pay for this. As Matt was saying and James are saying, there's little hacks, but there's really only 3 ways to cover your closing costs. One is a seller credit. A seller credit to cover those closing costs covers the closing costs. It's essentially a credit on that loan estimate, and it pays for those fees that you see on that loan estimate. It can't pay for more than them. You can't get cash back from that. You can only get cash that you put into the transaction. So that's one way. Lender credits. So we talked about that briefly. That's where I think Matt mentioned rates and costs are like a teeter-totter.
Teeter-totter, yeah.
Love that analogy too. That's how I explain credit. But if you have a lender credit, you're essentially going to increase your interest rate and essentially get a lender credit that can cover those closing costs. And the only other way to cover closing costs in most cases is you paying for them. So be prepared to come in with money or do one of the other.
The other thing to search the forums for is the 150 people who swear every time they've purchased, they've financed their closing costs.
Yeah, that's not a thing.
It's not a thing, never has been, and never can be. But those who believe it is, you don't want to argue with them. They're mean and vicious people and insist they have done it.
There are closing cost programs in some states. I'm not saying that those don't exist, but they are far and few between, and they always, I think James said, it's not free money. Most of the time, it's not free money. So those are my 3 ways to cover closing costs.
All right, perfect. I appreciate you guys joining us. Went through in great detail. So hopefully, if you're in the market, if you're buying now, if you're in a transaction, you got a lot of actionable information to make sure that you're getting a good deal, you're working with experts, and you understand everything that you're looking at and paying. So again, thanks for joining us. Thanks for the great questions tonight, guys. We appreciate it. And to the 3 of you, thanks for joining me tonight.
Thanks, Josh.
Thanks.
All right. See you guys.